This is another episode of me documenting the day-to-day process that I'm taking to achieve long-term consistency in the financial market. This is the second week of my top step eval, and this is the second week in a row that I have a positive outcome. I am profitable to end the week, which is good. I'm not trading non-farm payroll because I'm going out of town, so I'm going to end the week right here. We're going to cut it, secure the profit that I made this week, and walk away with it. So I finished this week green, but where I'm at right now, in terms of where I was at last week, in terms of equity high, is not that much of a difference, which tells me, number one, I need to be capitalizing on my winning trades more. I am not maximizing my wins. And number two, I still need to get good and get comfortable with my playbooks to work on setup selection and eliminate a lot of the losing trades that I take. Because you can see from my performance, my win rate is low, right? So the model that I'm trading is a low strike rate but high R model. Because if you look at the wins percentage, we can see it's only 27%. But if we look at the average win to loss, it's 4.43. So my winning trades are literally 4 times what my normal losing trade is. And that's great, which is why I'm able to be profitable with a 27% win rate. Now the issue is I need to raise this number, raise the win percentage, and then from then on out, I should be wildly profitable. How am I going to raise my win percentage? Setup selection. Getting good at identifying the right criteria and what I should do in that market, dialing in my market approach, continuously refining my model. That's all I'm working on outside of trading hours. Let me pop up the Miro board. And this is all I'm working on. Outside of trading hours, this is it. This is what I'm doing. I'm grinding all the time, all the waking hours that I have, and I'm just consistently refining my model. So after I have created this for my bearish premium gap opening setup, where the market simply has a gap up opening and then reverses to fill that gap, I've now eliminated my tendency to subconsciously hunt this, which allowed me to be successful today. That is the primary reason for my success today, because initially, let's view my day. Initially, I thought there's nothing of probability as price is going to open with little to no gap opening. There's NFP tomorrow and 10 o'clock ISM services PMI, which all tend to produce unfavorable conditions. On top of that, I thought the bias was not high probability. Does price want to complete the buy model and reach for Wednesday's high? Or does it want to fade lower towards Wednesday's daily low? Now, this idea right here is a problem that I've had all last month where I thought I could frame the possibility of both ideas. If I look at my session review and go to the monthly review that I completed last weekend, my market approach, I have a really strong tendency to frame the incorrect approach because I'm looking for a low resistance liquidity run. A lot of bearish incorrect biases looking for this setup, the bearish premium gap opening setup, where it's simply where the market has a gap up opening and then I'm looking for it to reverse and have a sell side low resistance liquidity run after 9:30. I'll show an example of that. I caught one of those last month. And this is my best playbook. This is my best playbook. It delivers a huge swing, very fast too. So because I've had so much success with it, I'm subconsciously hunting that on a day-to-day basis. And because of that, that has produced this tendency for me to want to sell short right at the market open because those happen to be my best trades. Like for example, if we look at this day, this is that playbook, right? And if I go to other examples of that from the previous month, we're going to see the same thing. So if we go to a 15-minute time frame, we can see kind of the same thing playing out where the market gaps up, opens, fails at the high day, then reverses and closes that gap. Now if we go to the following day, it literally set up on back-to-back days here, which is why this is my most successful playbook. And now I'm subconsciously hunting this idea on a daily basis. And this is why I tend to frame the incorrect market approach or the wrong bias. It's because I'm going into the trading day hunting this kind of move where we had a gap up opening, the market reverses, fills that gap. So when I come to the charts today, I was initially indecisive because I'm noting how this low did not take this low, right? So these are relatively equal. And let's bring this back real quick to here. Okay, so this is what the market looks like today before it opened. Now at this point in time, I'm thinking, okay, the market could have a sell side low resistance liquidity run to want to draw for Wednesday daily low because we've already taken Wednesday daily high. It could see a sell side low resistance liquidity run all the way to these lows because they're relatively equal. I have a strong tendency to hunt this because it's my most successful playbook. But because I did the work here, I now know that a very specific criteria is met with a very specific narrative when the market does offer this playbook, and that was not here today, so I eliminated the possibility for that to play out. So I'm not looking to be a seller at 9:30 because I know this criteria is not there, so the market's not going to make that kind of move. So automatically going into today, once I realize that, I know that after the bell, this is not going to be a large down close day with a huge reversal lower because it's just not setting up the criteria to do that. Because when it does that, I know that this is present, this is present, this is present, this is present, because I've done this work here. Now this is what I've done for one playbook. Once I get this done for all my playbooks, then I'm locked in. I'm good. Then I'm coming to the market with very specific criteria that I'm looking for and very specific moves that happen to unfold over and over and over again, and that's it. Now I have a model, now I have playbooks that I'm implementing on a daily basis, and that's it. So I know that the market is not going to break lower today because it doesn't meet any of this criteria. If it did meet this criteria, then we'd break lower today. So for that reason, in my market approach, this is what I was looking for. So I'm going to go with the idea that the market is going to still to attempt to complete the buy model and reach for Monday's high. So my higher time frame narrative was yesterday's range closed indecisive and price has not yet completed the buy model. So the market criteria is not necessarily anything that I was familiar with, but I would like to see price complete the sell model, deliver Asia low, rebalance to the 1 hour buy side and belt, sell side and efficiency, then see if it shows me any signs of strength. So I was looking to be a buyer after 9:30. More specifically, if I go to the hourly, I want to see price clear Asia low to stop out profitable longs before it makes its final push into Monday daily high, this level annotated right here. On the 15-minute, same thing, right? I want to see price clear out Asia low to stop out profitable longs before it makes its final push into Monday high. So what I was looking at, framing the logic behind this, before the market unfolded as it did, I apologize if you hear the dog barking, but I'm not going to edit this out. I'm just going to keep going. I was noting how the price traded up in the overnight session, right? We cleared Wednesday daily high, left the smooth lows here. So I'm thinking price is going to complete this lower time frame market maker sell model, where we have buy side of the curve, sell side of the curve. That is counter to the higher time frame market maker buy model that price has yet to complete. So we're clearly on the buy side of the curve from market maker buy model after the market took the daily low here, closed above it, displacement back inside the range. And on the daily time frame, what do? Well, this right here, this narrative right here on the higher time frame, what is shown on the higher time frame, the information given here is key to tell us what price is likely going to do today. So because Tuesday closed with a large discount wick like we see here, that's a sign of strength. We can go ahead and grade that to get an estimate of how strong the market actually is. So if price cannot even trade to the upper quadrant of that gap, that's a sign of strength. Notice how Wednesday's candle closed, the small range candle, it's kind of indecisive. This tells me the market is really comfortable where it's at. Notice how we also have an inside day. What tends to happen after an inside day? A large outside day, as we see here, that unfolded today. So because yesterday's candle closed like this, like I mentioned in the pre-market plan, I'm looking for higher prices today. I'm going to go with the tide. I'm not going to try to fade it and give in to my tendency to hunt a sell side low resistance liquidity run, targeting Wednesday daily low. I'm looking for continuation beyond this high because it has not completed the buy model yet. It has not completed the buy model yet. Another confluence to add is how these candles basically close within the same range, like this. So whenever the market does this and it consolidates like this, I tend to note that it produces a move like this. This tells me that the market is comfortable where it's at, sitting at these prices, because all the bodies are closing within this range, right? So what the market does, we have a 10 o'clock driver that manipulates the market lower first, clears the Asia sell side, completes the market maker sell model. That is counter to the higher time frame market maker buy model, and then we see the real move in price unfold. So one of the primary reasons I was able to be successful today was because number one, I defined the market criteria that allows for, or I defined the market criteria for my playbook where the market breaks lower at 9:30, has a large sell side liquidity run. That was not here today. Therefore, I know that the market is not breaking lower today. We're not breaking lower, we're going higher because it does not match the criteria of my playbook that says we are breaking lower at 9:30. So I eliminate that idea. Perfect. Second, Making the adjustment from the mistake yesterday, we had a 10 o'clock red folder yesterday, and I traded before that. Now, conditions were terrible before that, so I make the adjustment today. Today we have a 10 o'clock red folder. I waited for that to come out, and I noted how manipulative the conditions were before then. Do you see how back and forth all this delivery is? First of all, that tells me this is high resistance. And whatever move is high resistance, that tends to be the fake move for the daily range. This is what I've noticed just through experience. If you note how hard of a time the market has trading lower compared to trading higher, you see how it's just easy, boom, 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 consecutive up close candles, really large, really sudden, really fast like this. But on the way down, we have a lot of overlap, a lot of wicks, a lot of bodies, a lot of candles overlapping the previous range. That's high resistance. So when the market is making the Judas swing, that tends to be high resistance. That's how I know it's going to be the fake move for the day. When it's low resistance, moving very easily, very fluidly, that's how I know it tends to be the real move of the day. There's another thing that I've noted from my experience. So now I'm going to pull up the recording and just walk through all the annotations that I made today and what I was thinking intraday, because everything that I did today was great, and I found it to be very beneficial to me to keep me engaged in price action when I'm just making annotations on what I think the market is likely to do. So the very first annotation that I make is, this is the level mentioned in my pre-market plan, right? The draw on liquidity. If we go back to that, I'm going to go with the idea that the market's still going to complete the buy model and reach for Monday high. Okay, so that's my draw on liquidity. This is Monday daily high right here. So I'm noting how it traded up to that candle's high, and now we have a large down candle here. If the market was low resistance, meaning if it was having a really easy time moving lower, then it should just keep going lower from here. It should reject these up close candles. It should not come back to this gap. Therefore, if the market does come back to this gap after doing this reaction right here, I know that there's going to be a lot of overlap. I know that these conditions are high resistance, and I know that there's shit before that 10 o'clock driver. Therefore, I'm not trading at all. So that's the first annotation that I make. And I'm framing this sell idea right here just to see if it would play out, but I'm not taking it because the conditions are extremely unfavorable. So I'm noting this right here as well. There's a reason to draw back here. Why? Because it traded up to that high, but stopped just shy of it. What is that? That's priming of buy-side liquidity. That means the market's trading up to that high, but turning away from it, which forms what? Basically, builds the idea that this is an area of resistance. Therefore, those who are short, when the market trades up to this level and rejects it, are going to place their buy stop limit order above Monday daily high. That's going to create buy side liquidity. So now there's a really strong reason for the market to want to draw back there, right? Another thing that I'm noting, and this is a strong reason for why I targeted 23,552 and 50. Okay? So if it comes back to this gap, conditions are shit. I'm noting this. I'm still not interested in taking anything at all. I don't care. I'm waiting for that driver to come out. I'm noting how shit these conditions are. Look at the overlap. Look at the overlap. So a huge discovery that I made today is how I should approach days with a 10 o'clock red folder. Do not trade before it. Let me show you guys something. Okay, this is what I use as a daily price action log. So let's go to remove these filters right here so we can look at all the examples that I have. And let's select days with the 10 o'clock red folder. Any 10 o'clock red folder. Okay. Now we're going to look at the conditions intraday when the market has had a 10 o'clock red folder. In this case, the move was valid right at 9:30. So what I noted from just going back and reviewing days with 10 o'clock red folders, either the move is going to happen right at 9:30 or it's going to happen after the red folder comes out. And if it doesn't happen right at 9:30, then the conditions are going to be shit until that driver comes out. Let's look at this example. Down to the 1 minute. Look at how shitty this delivery is before that 10 o'clock red folder. Very back and forth, a lot of overlap. It's not going anywhere. The same thing here, right? This is an extremely, I remember this day, or no, I don't. This was a back tested day. So again, extremely manipulative, a lot of back and forth. There's really nothing in here worth doing, is there? Until the 10 o'clock red folder comes out. And then right at 10:10, and this is another thing that I've noticed. Listen to this, pay attention to this. When the market is high resistance in the opening range, in the first half hour of trading, meaning there's a lot of overlap, a lot of back and forth. There's no clear direction like it was today, and we have a 10 o'clock red folder. Usually the market clears up and becomes very fluid and very low resistance after the 950 to 1010 macro. So you'll see right at the end of 1010, immediately the market cleans up and becomes fluid and low resistance again. So you can kind of see that here, right? Right at the end of the 1010 macro, what happens? The market starts trading with direction, becomes fluid and clean. If you go to this example, it happens right at 9:30 on a day with the 10 o'clock red folder. So either it's going to happen right at 9:30 or it's not going to do anything at all. In this example, what happens? It happens right at 9:30. These are all days with the 10 o'clock red folder. Look at this. Completely untradeable. Completely untradeable. The move does not happen right at 9:30, and the day is literally untradeable. So pulling up all these examples, it's going to happen right at 9:30 or it's going to be untradeable. That's it. With a 10 o'clock red folder, it's going to happen at 9:30 or it's going to be untradeable. Untradeable. Basically untradeable, right? Give me a second, gotta let my dog out. All right, I'm back. Basically what I was getting at was it's gonna happen on 30 or the conditions are gonna be shit. And if you can see from me scrolling through all these examples, that appears to be the case, right? So I think at this point you get the idea, and I shouldn't have to show any more examples. So you have to know when these moves are coming. You have to know when to time them through your previous experience. So back to the recording. So look, I'm not touching this thing before that 10 o'clock driver comes out, and this is the adjustment that I made because of the mistakes that I made yesterday. So every failure carries with it an equivalency to success. That means if you have a losing trade, there is something of value that I can extract from it. And really, is it a losing trade? If you can learn something from that, that's going to make you a better trader. Is that actually a loss? Is that actually a negative? No, absolutely not. Absolutely not. Which is why your losses literally don't mean shit, but I am getting better. That's it. So another annotation that I had. So I'm noting the first, okay, right? You remember in my pre-market plan how I mentioned I'm looking for a drive below Asia sell side, this red line right here, to see if the market wants to reverse, right? Inside of the 1 hour gap, that gray shaded area that we're trading down into, that's the 1 hour gap. And the red line is the Asia sell side. So I'm noting how there's nothing really strong in here. You're seeing this move as a rebalance to rebalance the drop to make a lower low. So I'm not viewing this as a result, as a reversal. There's nothing really solid in here that gives me a solid change in the state of delivery. In order for me to consider this a change in the state of delivery, it has to cross the open price of these consecutive down close candles right here, and it's not doing anything of that. I wouldn't even consider this a change in the state of delivery, although we have down candle overlap, because it doesn't really reference anything. It's not removing liquidity from the marketplace, and it's not referencing a specific level within this hourly imbalance at all. So to me, that's not a valid change in the state of delivery. I'm noting how it's leaving this smooth edge here. I'm noting how the rebalance is high resistance, so I'm not thinking this is a real move. This is nothing really strong in here. Seeing this more as a rebalance, the drop lower. I'm just thinking that it's rebalancing to a premium of this impulse swing lower to then make a lower low, which is why I make this annotation. So it should reject this balanced price range and make a lower low. This is a bearish order block. I know this is a bearish order block because it rejects consequent encroachment of the new week opening gap. So what validates an order block for me is it either removes liquidity from the marketplace or it gives an indication of respect of a PD array. That's it. And I've mentioned this in my notes. Let's see if I can find them. I'm kind of getting unorganized here. Like I'm doing a brain dump right now. Eventually I'll go back and organize it. So what makes an order block an order block? It must reference a PD array and indicate respect of it, or it must remove liquidity from the marketplace. And that is what I'm using to enter these trades. So this is a bearish order block because it's in reference to the new week opening gap consequent encroachment and indicates respect of it. So as soon as that gets overlapped, that can be a sell right there to target this low. And that's it. So for a long idea, I would need to see some response at consequent encroachment, or the idea is likely invalid. So notice price spooling once the macro ended. So what time is it right now? This is at 10:17. So this is what I mentioned earlier, right? Let's go to a 1 minute. This is 10:10. This is the last minute in the 950 to 10:10 macro. As soon as it ends on this candle right here, as soon as it ends, what happens? The market becomes very fluid and very liquid. As soon as it happens, we have a bold face up close candle. The following does the same. The candle starts to get bold. We start to see separation, and it's very fast and fluid. So this is just an anomaly that I'm noting, that I've just noticed through experience. So now, explain another aspect of my entry mechanism. I guess it would make sense for me to pull up my notes. But I did this last night because I'm reviewing the stages of trader development, and I'm reminding myself the logic behind my playbooks and what makes me actually get into a trade. So, in order for me to get into a trade, to establish entry criteria, I need to know what I need to see in price. That's the logic behind the trade, the why behind it. So what is the why behind me actually putting risk on? What is the logic behind that? What do I need to see in price to confirm that idea? There has to be a why or logic behind it. The logic is simply your school of thought, the concepts that you trade. What is the logic behind the concepts that you trade that makes that entry right there make sense? So what is the logic behind the concepts that I trade that tells me that in that moment the market is strong and should be bought? I'm going to explain that. If we're on the 5 minute time frame, I trade algorithmic price delivery theory, whatever the fuck you want to call it. This 5 minute candle trades down, takes the Asia low, but it closed above it. Algorithmic theory suggests that is a sign of strength. The following candle opens, trades down below that candle's low, but closed above the Asia low again. Notice how it's also respecting the upper quadrant of the imbalance. There's two strikes right there that tell me this is probably strong. So if this is indicating a sign of strength, it's indicating respect of Asia low in the upper quadrant of that imbalance, and it's also showing me this same signature on the 15-minute time frame that we traded below Asia low, closed above it. Then I can anticipate a drive below this candle's low to fail. So I'm watching the market as it's trading below that low. Go back to the recording. As soon as I see this candle open, look at the displacement. Let's watch the displacement on this candle. Look how it just suddenly comes in. Boom, like this. Watch this candle. Watch how this candle paints. Right from the open of this 1 minute range, what happens? Instantly starts trading higher. Instantly starts trading higher. The displacement is so sudden that you can feel it. You can literally physically feel it. It's a feeling that the market gives you when you notice something has changed, when something has flipped. So I'm looking at this 1 minute candle. I'm seeing it displace back inside the range after I have those signatures on the 5 minute and the 15 minute. And I know that this is going to be a good trade. So note the work inside of this sell side imbalance buy side efficiency. Now, if the market is still bearish, this should reject the market. This should reject the market. It should send it lower, right? So I'm watching how this candle closes, and I'm noting this strong, obvious displacement after I have those signatures on the 5 minute, the 15 minute, and the 1 minute, all three time frames that I use to confirm a trade idea. I'm going to use this inversion fair value gap as a buy because an inversion fair value gap is also a change in the state of delivery. So I'm going to set my limit buy order right at the consequent encroachment of that gap after I see this displacement on that 1 minute range. I have a high degree of confidence that something has changed and the market is now going higher in alignment with my pre-market plan. So I get filled there. Now I'm noticing, boom, look at this displacement in my favor immediately. At that point in time, I know that this is going higher and I should have no worry whatsoever that I'm incorrect. So I set my initial sell limit order to take 2 contracts off at the 9:30 open price, which you can't see on this chart because this chart is naked, at 23,580.50. But I noticed the strength in price from this displacement, and I'm thinking I could definitely squeeze a little bit more juice out of this lemon, annotating this gap It has to respond to this gap here if this is to be bullish. I don't want to see this get ran through. And then boom, what do we see? Low signatures of a low resistance liquidity run because it trades down into that gap and boom, it instantly leaves it like that. That is exactly what the fuck I want to see. That tells me I am 100% on side and I should have no worry in the world that this thing is going to go lower. It barely traded down into that gap and boom, instantly ran away from it, overlapped the down candle. That is beautiful. That is perfect. So instead of taking profit at the 9:30 open price, I'm thinking I can squeeze some more juice out of this lemon. I move my trim 2 contract, my first partial at first presentation. I think that makes sense for the market to trade to that level and for me to take off. So I thought it was just going to rip right through it, which is why I'm executing at the market. I was going to sell into strength, but I noticed the rejection at the midpoint, and then I go ahead and trim 2. So at that point in time, this should be stress-free, worry-free. At this point in time, what do? There's 58 seconds left in the recording because I know to just close out and literally do nothing and just let the market ride for my final take profit. Now the issue is here is that I could not resist the temptation to micromanage this trade. And I came back to the screens after I was high on goofballs, literally straight up. This thing was running, boom, like that. So I knew I had to calm my nerves a bit, like separate myself from the screens, relieve everything that I was feeling. I went outside. I literally did some yoga in the sun, in the morning sun. Came back inside. What did I do? I opened up the charts again. Noted at 11 o'clock, the first thing the market did was open, traded up. I was watching this. I was watching the respective Wednesday daily high. This candle was a large up close candle and it snapped back down inside the range. It's so close to taking Monday daily high, my final take profit. And I'm thinking just close out. So I literally talked myself out of this position by micromanaging it, by failing to resist the urge to have to sit here and look at this thing while I'm in open profit. And I sold short, I sold early. Literally all I had to do was nothing. I had the right idea. I closed the charts, I ended the recording, and I was like, okay, I'm going to be done. I'm just going to let this thing ride out. That's it. I came back, I micromanaged the position, and therefore I was not able to maximize the win. Had I literally done nothing, what happens? A couple of minutes later, take profit delivers, I would have made an extra 30 handles on this trade. So I'm not maximizing my wins because I continue to sit here and micromanage the position. Eventually, I want to get to the point, though, where I'm riding this thing to the end of the day, and I'm making 200 handles in a swing, and I will get there 100%. But for now, I'm making the mistake of micromanaging the trade and talking myself out of that position. So the things that I learned from today, number one, you have to know your playbooks and be comfortable with them. You have to know what it looks like when they're going to be there and especially what it looks like when they're not there. Second biggest lesson from today is stop micromanaging the fucking position. Set and forget. Trim 2/3 of the position and just let the rest ride. That's it. That's all you have to do. So I made the same mistake on the first winning trade that I took on the eval. And that, again, led me to fail to maximize the winning trade that I had here. I should have secured so much more. So I should literally be $1,000 in profit on this account already. But I'm failing to maximize my winning trades. And that is an issue. But it's a good issue because I'm no longer a losing trader. I've been break even for the past 3 months. If we look at my P&L in terms of R multiple, I have not been a losing trader in the past 3 months, okay? So I'm off that phase. Now it's about getting really comfortable with my playbooks, being able to consistently execute on them and manage my risk and optimize and maximize my winning trades. That's it for this one. Talk to you next time.